No one wants to write a big check if they're like, I don't really know what's going on in here, right? And so, the baseline is you have to make it credible. But once you've made it credible, then it becomes all about profit and multiple.
Grab your notepad, iPad, or any other type of pen and pad, guys, because Erick Danzer and I are going deep into the financial practices and technicalities of WordPress exits. Former owner of NextGEN Gallery, Erick Danzer has first-hand experience in making business exits profitable for all parties, and he's agreed to share these insights with us to help you max out the financial value of your business in 2022 and beyond. What would you say is the best time to sell a business?
The time to sell is when you've got those variables all moving in the right direction, because that's what produces maximum value. And so, when everything's going great, that's the time you kind of least want to sell it, but that's the time when you also get kind of maximum value out of it.
Aside from his success and popularity as a serial product leader, Erick has implemented tons of valuable practices over the years to boost the profitability of his WordPress products, which has led to several profitable acquisitions for him as a buyer and a seller.
There's two cases when people decide to sell. It's because they just get tired of something, right? And then they want to sell it. Or it's because you've made a decision to sell at like maximum value or something like that. Say you've calculated the choice. There's very predictable things that you can do starting years in advance that will prepare it so that if you decide to sell it sometime, you're ready for it and you can get maximum value for the sale.
Okay, so it seems like prep is the key here, but before we get into what I should prepare, how soon would you say I should start thinking about my exit before I actually want to sell my business? Would you say I should build my company for an exit starting on day one?
Yeah, I would, because it makes everything easier. I think a lot of times when you're new, you're not thinking about this, or it's so far in the future that you're like, it doesn't really matter, right? But if you just get it structured first, and it's a little bit of hassle up front, but it's not that much hassle. And once it's done, it's done. If you go out without it, you're 2 years in, here's exactly what happens. You're 2 years in, you go to sell it, and your financials aren't clean, they're not separated from your personal finances. The answer is you can't sell it.
In 2018, Erick decided it was time to pull the trigger on selling NextGEN Gallery, only to find that to get a profitable deal, he would need to legally and financially restructure his company. This unwelcome bombshell forced Erick to wait 2 full years.
Once you've got it organized correctly and you're doing your financials correctly, from that point forward, you need at least, at minimum, a year of everything done correctly before someone's gonna write a check to buy something for you, from you.
And this is the first major takeaway for WordPressers running a business today. Don't wait to prepare your business for a sale when you're ready to exit, but rather properly structure your business financially to begin with so it's easy to sell when you want to. How do I bake this in? Like, what's the first step in making my business exit ready?
The simplest starting point is really putting your company in an LLC. Once you have that structured, it's very important that you separate your personal finances from the business finances. So, create separate bank accounts, right? All the revenue goes in there. You pay yourself in a predictable way out of that account. It's not your own personal money. And so you think of it as if it's its own business, because it is. It has revenue that comes into the bank account, expenses that go out, right? All those financials can be tracked from its own bank account. And then, of course, you have to prepare some monthly statements, or at least for now, keep track of, month-to-month revenue and expense. In an ideal world, once you have an LLC like that, you want to make sure that it's showing up on your tax returns kind of as a separate entity.
Though this procedure may slightly differ based on your geolocation, whether within the US or outside of it, the concept is the same. Keep the records of your business and profits and losses clean and separate from your personal accounts, running the numbers through accounts exclusive to your business. And 2, collect government tax returns validating those numbers to ensure that everything is legal and above board when you sell the business.
And so that's like the gold standard for nobody messes around submitting financial numbers to the US government, right? You just don't do that. And so, so you're submitting multiple years of tax returns based on a single theme brand to the IRS. That means that when a buyer comes in and looks at them, and they can just have a really high level of confidence that what you're reporting here is actually real.
I've also heard a few cases where the seller owns a number of different brands, and they're like, okay, I want to sell this brand and that brand, but keep owning and running this brand, and they can't sell those brands separately from the one they want to keep because they aren't keeping them financially separate.
Yeah, it's interesting. I don't think we talked about this in advance of the meeting, but what you're describing, I told you that I restructured my company starting in 2018. This is exactly the problem that I had. So I had created a big umbrella company with lots of, so Tesla, Show Themes, Imagely, Photocrati, and then a number of other businesses that aren't even WordPress related.
So if a buyer was interested in buying one of the brands under Erick's umbrella, and let's say out of 1 million in annual revenue for all brands combined, that one brand was bringing in 200K, Erick would have no way to validate that specific brand's value. And the buyer would be in the dark as to how much that brand is really worth.
The only debt finance you can do in that circumstance is you have to go to much more informal debt markets, which are much more expensive to use, and you'll be lucky if those will work as well. But in any case, what I did in 2018 is I took all of those pieces and I broke them up and I put them in separate LLCs. So I kept my umbrella company, but then every plugin or theme business became its own LLC underneath of it, like a subsidiary.
Remember last week's video where I discussed acquisitions with Syed Balkhi? Where Syed was like, in many cases, developers don't know. Erick's story is an outstanding example of the benefits of having control over your financial data. Having established a separate LLC in advance not only saved Erick months or years of prepping his business for the transaction, but actually enabled him to sell the business to a buyer who was taking a loan.
The buyer used something called an SBA loan. SBA in the United States is the Small Business Administration. So that's a US government funded entity that does a variety of things to help with small businesses. One of those is that it gives loans, right? So when the SBA is going to give a loan for a business acquisition, it gives a loan to buy an entity. So that LLC that I set up, it wants to buy that. And in order to do due diligence, so once you bring in the SBA, it's a government entity, right? So the level of due diligence is quite sophisticated now, right? And so what they, as a simple example, what they want to do, they're lending to buy that thing. They want to know the financials of that thing that the person wants to buy as well. So when you actually submit, in my case, I submitted tax returns for the LLC to the SBA. The SBA looks at those, make sure the last couple of years of tax returns make sense, that you're profitable, are you growing, are you not growing, right? But they also want to know that whatever the buyer says they're buying exactly matches what's on these tax returns.
So, as you can see, the way you've prepped your business for the sale, or the way you've managed your financials to begin with, will not only drive your value up in the eyes of potential buyers, but may also pull in additional buyers who would need to take a loan to fund the acquisition.
If the buyer says, I'm buying a company with $100,000 in revenue, the SBA wants to look at that tax return and see exactly $100,000 in revenue. If they say it's $20K in profit, they want to know that the LLC recorded $20,000 in profit with the U.S. government and the IRS, right? And once they do that, then they're willing to loan on it. And this becomes important because, again, most people don't have the money laying around to fund an acquisition in cash, right? And so when you've structured it that way, the sale that I just made of Imagely, it could not happen without these organizational structures in place, right? Because the SBA won't lend if anything's messy or it's out of line.
So, as we discussed previously, I want to dedicate this second part of our talk to evaluating my business as a seller, and how would I, as a founder, who never previously made an exit, how would I know what my business is worth?
No one wants to write a big check if they're like, I don't really know what's going on in here, right? And so, the baseline is you have to make it credible. But once you've made it credible, then it becomes all about profit and multiple. If I was a business owner and I was watching a video series about how to do it, those two numbers, how is profit determined and how do I know what multiple I'm going to get? Those two things are the critical things you have. And there's little levers inside of each of those where you can maximize the profit number,
right,
either short-term or long-term by doing different things. And you can maximize the multiple if you know what components will influence the multiple upward or downward.
That makes perfect sense. So when you say profit, what are you actually referring to? Because I know there's different ways of calculating what profit is.
So the way profit in our industry, if you're in a big company and you're doing a merger and acquisition for Fortune 500, they use EBITDA. In most of our industry, they use something called seller's discretionary earnings. And seller's discretionary earnings is the actual profit reported by the business, but also your own take-home pay. So I actually pay myself an actual salary, on a W-2 form in the US. So I get a pay stub and I pay taxes on it every month. So that actually goes as a line item on your financial. So it reduces profitability because I'm paying myself, right? And so you've got my pay, but then you've got profit on top of that. So in a lot of our industry, you actually combine those things, and you use as a measure of profit something called seller's discretionary earnings, which is basically everything that the owner takes out of the business.
Another formula used to calculate profit in the case of bigger businesses is EBITDA, which does not calculate the business owner's salary as part of the income. But in our case, Eric will be referring to a business's SDE, a metric used to calculate the profit of smaller businesses, which is typically more relevant to businesses in our space.
This becomes quite important, especially for smaller theme and plugin developers, because you're thinking, okay, let's say you have a $50,000 plugin company, you're running it yourself, so you're doing all the support and everything. What that means is that if you take out the profit and you take out whatever you're paying yourself, the amount of expense is actually pretty low, right? I mean, you have like hosting and maybe some marketing or affiliate fees or some other things, but out of 50K, if it's 10K, I'd be surprised that you're actually paying out if you're doing the work yourself, right? So that means you're making 40K out of it. So your seller's discretionary earnings is 40K, right? So that's the starting point, and that's actually a pretty healthy number for a $50,000, plugin company.
Great for one-man army solopreneurs, right? However, calculations based on SDE have their complications for people like Eric who have a team on board with them.
This was a difficult thing for me because in some sense, your smaller developers have an advantage here, right? Because when you're running something yourself, especially if you are a developer, that means you're capturing you're capturing it as income, and that means it goes into SDE. Now say I bought that business from you, right? The way I've been doing it for the last 10 years, I'm not going to do the development myself. So what am I going to do? I have to put a developer on it, right? So now you take the same 50K, right? Now maybe it only needs half a developer's time. So I have a developer on my staff or something, but now I have to allocate half their time to this thing. And let's say, that means that I'm paying $30,000 worth of salary, right? So if you remember, we had 50K, there was 10K in cost before. Now I just added 30K in dev salary. So now the costs are 40K, which means the SDE is only 10K. So I just reduced the value of that company from 40K in SDE. Let's assume that we were working off a 3x multiple. Before it was 120, 40K times 3. Now it's 10 times 3, it's 30. So I just reduced the value of that company from 120,000 to 30,000 that quick, right?
So the bottom line of your exit value will not only depend on your existing metrics, but will also be influenced by the number of employees you've brought on board with you over the years. The more the merrier? Not really in this case.
What you probably don't want to do is go hire a bunch of people. If you've been running by yourself, just keep running it by yourself, because now it goes into SDE as a thing. Now, it's worth noting that a lot of times, like a more sophisticated buyer, like if I was buying it, I would know this. And so what I would probably come to you and say, listen, I know that your SDE is 40, but you know that I'm not going to run it myself. I'm going to have to staff that, right? So like its value to you might be 120, but its value to me is going to be more like 30, right? So we're going to have to meet somewhere in the middle.
This is an important insight that some buyers aren't really interested in running things themselves. So it kind of boils down to, is your buyer a financial investor buying for the profit margin, or are they another entrepreneur buying into their new job? That said, what would be a preparation method for companies who do have a small team?
So what a lot of bigger companies like mine would do is they start trimming staff, right? So, you basically trim it down and run it on a skeletal team structure, and you prove you can do that for 6 months or a year. But by reducing staff, you've increased the profitability. And as you can see, that number can move quite a bit. It really affects the valuation as you increase or decrease profit.
And then my exit value would be SDE, seller discretionary earnings times what? Because we hear of a big range of multiples, like 1 to 6 or 2 to 6.
So you're at, we've determined you have 40K in SDE, seller's discretionary earnings. That means the sale price could be anywhere from say 40 times 6, 240,000. That's a pretty big range.
Absolutely. And I'm like, what metrics would determine where I fall within that range?
So the first is the revenue predictable? So moving toward a recurring model as opposed to a single sale model, huge difference. The reason is, if you don't have recurring revenue, every month you start at 0 and you have to make new sales to achieve the same level. That's very difficult. If you have recurring revenue, even if next month you don't make a single new sale, you still have the same amount of sales, right? It's just very predictable, right? So that's number one. Number two is whether it's growing or declining or stable, right? So declining, it's hard. It can be hard depending if it's declining too much, it can be hard to sell at all. Nobody wants to buy something that's like falling off a cliff, right? If it's incrementally going down, you're probably okay. If it's flat, so let's say you have recurring revenue and it's flat, you're probably looking almost out of the gate at a 3x multiple. So you have 40K in SDE times 3, 120,000. As the growth rate goes up, let's say you're growing up, you go from 3 to 3.5, maybe to 4. It's very hard to push above 4. You have to have a really high growth rate or something very promising to get to higher than that, right? If it's kind of incrementally kind of going down, or you're, maybe only a portion is recurring revenue or something, you're probably looking more at like a 1x or 2x multiple on your SDE or something like that.
So the multiple actually sounds like an evaluation of how fast and perhaps how reliably the business is growing. What else comes into play when determining the multiple?
So you've got recurring revenue, you've got whether it's going up or down, and then you've just got some other like fundamentals like for the business. The quality of the brand. Is the software up to date? Am I going to have to rebuild this software like from scratch, right? Am I buying something that's like totally obsolete, right?
For those of you making it to this part of the video, first of all, kudos for tapping into these hardcore financials. And though in reality my call with Erick didn't really end here, when I sat down to edit this video, I thought this would be a good time to stop, save some of the topics we covered for future videos, and recap so you guys can digest what we've covered so far. Number 1. The first thing you need to do if you want to make a profitable exit is run a profitable business. So while it may sound like I'm stating the obvious, it's still important to understand that your focus should be on running your business well, not on making the exit. Number 2, establish your business as a separate entity with its own taxes, bank account, payment processor, and practically any type of account designated exclusively for your business. And don't mix it up with any other unrelated personal or product finances or data. Number 3, after you've separated your company's financials, maintain positive growth for at least 1 year. Drive your profit up if you can, and document everything. Income, expenses, taxes, and all types of conversion and churn. And then after a year, before seeking out a potential buyer, do number 4. Assess your value by multiplying your SDE times 2 or less for a product in decline, and 2 to 3 for a growing product. Erick, any last piece of advice you'd like to share before we say goodbye?
This is one thing that it's very hard to get used to when you're running one of these things, is that, you're like, do I really have something that can sell? I mean, that's the question that you end up asking yourself. Like, when you look at, you own a house, right? That's an asset. It has actual tangible value, and it's undeniable, right? You own a plugin business. Like, does that really have tangible value? I mean, it's like you don't really know until you kind of go in the market. But if you've created a consistent, credible foundation and you're actually profitable, right? And you've got a couple of these other things. So, maybe it's recurring, it's stable or whatever. The answer is yes. It's an asset that actually, truly, genuinely, sincerely has value. And you can go out in the marketplace and you can sell it. And, you can put it on Flippa and probably get 1x, in 30 days, right? Or you can work through a broker and try to get a higher multiple on it by doing a little bit more front end work to get it prepared.
If you found this episode useful, subscribe to our channel for the next videos of the Gamechangers. I mean, like, where would you look for interested buyers?
If I was selling a large company, I wouldn't actually approach a buyer. I would go to a broker. And this is one thing we can talk about, is under which circumstances would you go to a broker or not?